dividend versus dividend yield. When I was a beginner in the stock market and investing, I would see these terms and I wasn't quite sure, are they the same thing? Are they different? If so, what makes them different? What influences each of them? So those are the things that I want to talk about and share with you in this video. But the good news here, nothing is complicated. It's very straightforward. So let's first start off with what is a dividend. Now, a dividend, I like to picture it is this. It's a thank you card. So a thank you card here, and don't laugh at me, but so here's a little envelope. There we go. And this is just saying thank you. So we'll call it TY, thank you. So who is sending this thank you card? The company is sending the thank you card. Who are they sending it to? They're sending it to anybody that is investing into their company. But the cool thing about this thank you card is this. Within the thank you card, there's some actual money in it. They send you money. Now, I want to be very clear. This is a metaphor. They are not physically send you a thank you card that you get in your mailbox that has cash in it. This is all done, electronically via your online broker. But for example's sake, the company is going to send you a thank you card, and in that thank you card is money, which is the dividend. So, okay, well, what's influencing this? Well, the company itself. What's influencing it within the company? How well the company is doing. Are sales doing great? Are they, coming up with new products and services and continuing to grow? Maybe they're just a kind of a good old-fashioned company that constantly has cash coming in, and they're just sending it back to anybody that is willing to invest into their company. So it's all dependent on the company itself, and that is dependent on how well or how poorly is the company doing. Some companies don't do this at all because they don't have cash to send out, or other reasons. So I also want to get that not all companies pay dividends, but that's what a dividend is. Thank you card from the company that's got some money in it, and it will pay you for every share that you own in their company. And for example's sake, and just math's sake here, let's just say that the stock price of this company that we're talking about, so the stock price is going to be $110, right? So the stock of the company we're talking about, 110, and the dividend that this company is paying, let's just call it at right here, $2.25. So $2.25 is the dividend amount being paid, and 110 is the price of the stock itself. And we need these numbers because that's where, when we hop over to dividend yield, is where we're going to figure that out. So the way, and again, this is very basic math. You just need a calculator, know how to do some division that you learned way back when. So all you're going to do here is you're going to take the dividend that we just talked about. So that dividend amount that shows up in the thank you card. Whoops, did not mean to change that to green. There we go, the dividend, and we're going to divide it, maybe you guessed, by the stock price itself. Let's just call that the SP, the stock price. So in other words, the way this, and I should also note that in order to convert this to percentage, because yields are always percentages, but in order to convert that to the percentage, remember you got to multiply by 100 at the very end of the equation. So as far as our example here is concerned, we're going to take 225, we're going to divide it by 110, and just to show you, and not trying to insult anybody's intelligence, but really to illustrate how basic and easy this actually is, we have $2.25. We're going to divide by 110, and then remember we got to multiply that by 100 to convert it to a percentage. And right there, the dividend yield on this would be 2.05%. So 2.05% at this moment in time. But let's consider a few other things. Let's say that the stock price, so now think about this equation. What happens if this stock price goes up? And now it's at $150. What does that do to our dividend? Maybe you can already tell that via looking at the equation itself, but 225 divided by 150 multiplied by 100. Now you're at a 1.5% dividend. dividend yield. See, you got to be very particular. Dividend or dividend yield. You're at a now 1.5% dividend yield. So in other words, as share prices go up and up and up, that dividend yield, assuming that the dividend itself is not changed, is going to go lower and lower and lower. And I bring all this up because what you need to be careful of is, well, what happens if the share price goes down? So let's just say that it's not 150 now, it drops down to 40. Well, let's quickly run through that math because I have no idea what that would be. But the good news is it's not a fancy calculation. So 225 divided by 40 times 100. Now we're at a 5.62% dividend. But let's say this. Let's say this now goes down to 5. So yes, from 110 to 150 to 40 to 5. And stick with me because I promise there's a very valid lesson in all this. But 225 divided by 5 times 100 equals 45% yield. And that would be, what is being paid to you. But here's the warning. I get that sounds amazing, but what is causing that to happen? What caused the dividend yield to get up to 45%? Well, the fact that this number down here got smaller and smaller and smaller. And what is that number? That number is the stock price. So you got to think and ask yourself, why does this company's stock price keep dropping and dropping and dropping? And wow, now it's all the way down at $5. Because more than likely, they're having some massive issues at the company. They're having some massive problems at the company. And the thing with the dividend, so let's set the dividend yield aside, talking back to a dividend is, if things get that bad, this right here, this can completely go away. Known as just stopping the dividend. They can quote unquote cut the dividend. Maybe now they're like, okay, well, we're really struggling as a company, so we're only going to do, 5 cents per share. So that's what you got to keep in mind. Don't just go and seek out dividend yield, because if you find really high ones, you got to remember that the reason why that's so high is because the share price is actually down. And is the share price way down because of bad things going on with the company? No, maybe not. Maybe it's truly a good deal, but you just don't want to rush out there and say, okay, I'm just going to find the highest dividend yield, and then that's what I'm going to invest in. Because that dividend itself, like I said, can disappear, and then you can find yourself in some very bad, stock investments if all you do is focus on that dividend yield and don't consider any of those other applications. But that is the difference. Dividend is just the amount the company is sending you and paying you via the thank you card, and then the dividend yield is just a percentage of whatever that stock price is. And another way to look at it is the dividend yield is the interest rates that is paid to you. Right? Usually we're used to having to pay interest rates for, car payments or mortgage loans or credit cards or whatever. But in this situation, it's actually an interest rate being paid to you as an investor, in the form of that thank you card. So I hope this helps. I hope this now allows you to have some things to think about in regards to being careful about dividend yields, but also just the basics of what a dividend is, what a dividend yield is, and what influences each of those. So if you have any other suggestions for videos like this, just kind of investing basics, then I'd love to hear them. I always do read comments, and if there are any other suggestions, then I can't quite make a promise that I'll do a video on it, but I will certainly can promise that I will consider it and potentially, get another video out there. So if you enjoy these, please hit that like button, leave a comment down below, check out the channel as a whole. There's a good variety of videos, and if you like what you see at that point, I would love to have you as a subscriber to the channel. Everybody take care and have a good one. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.